Good afternoon and welcome to this live webinar. I'm Andrew Naparotic and this is the first webinar in the Impact series brought to you by Practice Advisors 360. This series will cover COVID-19 related topics which are impacting the businesses of healthcare practitioners today. These webinars will be short, insightful and purposeful and will provide meaningful information relative to today's COVID-19 economic environment. This particular webinar will focus on access to capital. It will run for 10 minutes with 5 minutes of additional time for questions and answers at the end. It will cover a snapshot of accessing capital for reopening businesses, ranging from the Payroll Protection Program to how we should look at finance and capital as a vehicle to resuming business as usual. I'm excited to be joined by the founder and principal partner of Practice Advisors 360, Brian Choate. Brian has over 20 years of experience in healthcare, focusing on providing financial and capital solutions. He's also a recognized thought leader in helping practices define and implement capital strategies and banking relationships, including providing market analysis, sourcing debt and equity, and advising practitioners on purchase and exit strategies. Brian, welcome to this webinar today. Let's start with the Payroll Protection Program. What has happened in round two?
Thank you, Andrew. Appreciate the opportunity to discuss the access to financing, access to capital. Never have we experienced such a unique time where all small businesses are seeking capital and the paths to capital seem to have been concentrated around just single programs. So we need to understand what those programs look like or what the program looks like currently, and then what is the next step in access to capital after the program runs through, which is we're expecting it to be about a week to run this through. So regarding our focus on current access to capital, the Paycheck Protection Program, we are now into round two. This was designed initially to get capital into the hands of small businesses to navigate what was considered to be, I think, the initial consideration when the administration began to shut the economy down, but this was going to be a relatively short-term process. This is starting to elongate, and the first round of the PPP only ended up funding roughly about 1.3 million of the 36 million potential businesses. So we're into round two, and the status of round two, for an update on that, the Paycheck Protection kicked off on Monday morning. As of last night, the SBA reported that 476,000 loans were approved for $52 billion. The program itself on the second tranche has 310 billion allocated. And so the estimated run on this program is probably through the end of this weekend, early next week at the latest. We expect the intensity to pick up on the drawdown, just based on the fact that the systems have been the only thing holding back the processing. As a matter of fact, when the window opened for the second round, the system for the SBA that receives requests from the lenders crashed. So what we're seeing right now is it's slowly coming into an efficiency. We expect the drawdown to continue and really pick up. I would be very surprised if this fund lasts through the end of the weekend. What are the current gaps here in the PPP? Round two is very similar to round one. They haven't been able to solve some of the design flaws around the Paycheck Protection Program to begin with. A lot of the small businesses heard when they hear the program, they hear emergency capital, they think of operating capital, balance sheet, and things of that nature. But what this program was really designed to do was to deliver unemployment insurance. And so, and it's going out through the employers. So we're able to, as a small business, file for and receive capital, but really 75% of that capital that we receive has to be deployed out to our employees across an 8-week period of time. What makes that so difficult is that over these next 8 weeks, we're not really sure what businesses will be functioning and to what degree of functionality. And we're not really sure what the psychology of the employees will be, whether or not they're currently earning more on unemployment or they have a position in some of our healthcare practices that they consider higher risk. So some of the administrative staff in dental offices may consider that higher risk, and they may not be running to come back. And so regarding gaps in the program, I think you would define the first one as the design of the program is just a little bit of a differential between what the receiver, what the small business expects the program to do and what the legislation was actually designed to do. Second gap in this program is pretty extraordinary too. It has a lot of impact, and a lot of people who are in round two are in round two because of what happened in round one. We're calling this a processor gap. It's really on the banks. And so when this program was designed, they designed the program around itself. So to be able to move the funding out quickly, they took the underwriting capacity away from the banks, and they asked them to do it self-certified and just process it quickly. So these are self-certified, non-recourse loans. What banks did to reduce their risk in that was they wanted you to go through the banks that you held your deposits at. That led to some significant underperformance by some of the larger banks, where just given the surge of volume, their IT infrastructure actually failed. So banks like Bank of America and JP Morgan ended up processing less than 10% of their total portfolio, mainly because of the volume surge and their system failure. But that leaves a lot of our clients sitting there prepared and ready to go at the opening of the program and still not funded. So going into round two, the biggest gaps that we have and the way that it's playing out is very similar, is we have a design flaw where a lot of the borrowers who are taking the capital are not sure how to utilize that capital properly. And we have processor gaps. So what we've been doing to try to solve processor gaps for our clients is obviously identifying the most efficient secondary providers. Those are typically SBA providers with efficiency around communicating and interacting with the SBA allocation system, which is called ETRAM. And in addition to that, the fintechs. Fintechs also have the same, just a stronger ability to communicate and work through the ETRAN system with the SBA. So we've been filing, and I think this is probably the best way to approach bridging those gaps, is we've been filing backup PPP applications through the good secondary providers to make sure that our clients are covered. The ETRAN system, the SBA system, does not allow for secondary or multiple applications to get through. So there is a bit of a protection on this. We're not actually applying and receiving multiple loans, requiring us to withdraw them. We're simply using multiple sources to make sure that we get an allocation number for our clients. That's one way to bridge that gap. What's still confusing about the program, honestly, there's a lot that confuses about the program, but it really distills down to the two things that we just talked about. The most confusing thing about the program is the utilization. The borrowers don't know what to do with the funding if their business is not up. And the requirements of the program, as noted, require that they utilize the funding within the 8 weeks after they take it towards their employees. A lot of these businesses are going to be going on 8, 12, 16 weeks where business isn't fully up and operational. And that's leading to, I think, a lot of anxiety about how to stay within the confines of the program. The second level of anxiety against the processor and the visibility into the program. Once the application is filed, whether it's us filing it for our clients or clients directly, we're definitely noticing the highest degree of anxiety is we don't get any updates. And so that I think those are the most confusing things that are still going on the program. But I think what's important about noting that is that the program is also probably going to run just through the end of the week, and then we'll be moving back towards normal course. When I say normal course, nothing is normal at this time, of course. But what I mean by normal course is the traditional lending avenues outside of these federal, this type of specific federal program. So moving from the PPP program and thinking about accessing capital on the backside of the event, we're going to be discussing what options are going to be available to accessing that capital. Unfortunately, it's probably not as broad as is typical in the market, but nothing right now is typical. Most small businesses are experiencing significant impact right now, not just from obviously stopping the operations, stopping the cash flow, drawing down AR, furloughing employees. All of those things are really huge challenges. And then the challenge and the size of that challenge and the scope of that typically requires the ability to access capital and some operating capital, how to rebalance, how to reposition the balance sheet and get ready to operate on the other side of this. And so what we're going to be looking at in terms of options to accessing capital is just how COVID-19 is impacting the lender market and what that looks like for us. So if you look at the way that COVID-19 has impacted the global economy, and just staying focused on our side of things, cash flow stopped. It was simply paused and it stopped. And so with that, government intervened and created programs like the PPP. They used banks to distribute those programs as a means to reduce adverse selection of actually taking a scarce resource and getting it out directly to businesses when they know that it's only really going to cover 10 to 15% of the total small businesses. So by doing that, they've really used what looks like the Defense Production Act for banks and commandeered them to distribute the capital. But what they've done in addition to that is they've taken all the bank's operational bandwidth, pushed it forward on a program that they're currently just finishing up probably this week, tied them to the backside, which requires an audit provision on that, which could tie up lenders even further. They've put onto the balance sheet of lenders low income earning assets with high risk. These are non-recourse loans. These PPP loans are non-recourse and they only deliver 1% in terms of an interest rate. So for banks, they have high risk on adding those assets. They have operational bandwidth issues in processing these and then potentially doing an audit for the backside of the program. In addition to that, they're expecting to have some workouts on their balance sheet. A lot of businesses here, we're talking about how to access capital, and a lot of businesses don't have access to capital, and they might not be able to navigate this scenario. Banks understand that. They're prepared to have a lot of write-downs going forward. So the tolerance and the appetite for banks, our traditional senior debt providers, is diminished going into this the backside of the event. And so what we're going to think about for our clients is how are we going to navigate this and how are we going to address it? So if we look at the market with our traditional senior debt providers, what we've always had for access to capital through them are 10-year terms, sometimes up to 100% financing. They would lend 3 to 4 times funded debt to EBITDA. These were good terms. These were Vantage Point matters, but I mean, prior to the event, we'd say that the access to those type of terms was tightening. Now, of course, post event, we might say there is no access to those terms. We'd love to go back to those days, but those were the traditional basis of where the small businesses were funding their launch or their expansion or their operations overall. Where we're going now with banks unable to really participate in the same manner in which they were is probably looking at an environment where you're dependent on federally backed programs. We just discussed the PPP. That program is wrapping up. There's another federal program called the Main Street Lending Program that was included in the CARES Act. That looks like it's designed more for mid-market businesses, but we have, of course, clients and businesses that are of that size. That program probably won't be finished in terms of guidance and lender feedback and ready for delivery until end of May, early June. So we're still pulling information on that. But then your other federally backed programs are your traditional SBA programs. These are 7A, 504, express programs. You probably heard the terminology and you may have thought, I'm never using those because it is a pain to go through the process. But here I think that's going to be our primary angle and avenue to capital. We have to get used to, we have to be prepared for how to access those and what that looks like. Banks are going to have no other options in terms of lending into this environment. They cannot do risk profiling. They have too big a gap looking back at 2020 actual performance history. They have way too much uncertainty looking forward. We don't understand consumer confidence. We don't understand unemployment. So we would expect the banks are going to be looking to the government to take that risk profile off their hands. So what we're looking for here, as we focus on accessing capital on the backside of the event, are the federally backed programs, the SBA backed programs, the traditional SBA programs. That's probably going to be 7A and Express. And what we're specifically looking on those programs is to make sure that the program itself is funded and to make sure that some of the enhancements to that program, which we saw in 2008, like moving to a 90% federal guarantee, really takes the risk off the lender and just turns them into, again, distribution facilities. We'll be looking to make sure that the actual aggregate exposure cap that was raised for the PPP, it's typically $5 million aggregate exposure per beneficial owner, so per borrower, where that moved to 10 million in the PPP legislation. We are not sure that that's going to hold, but we're looking to see if that holds. And then we'll be looking at what lenders will have the operational bandwidth and the actual SBA understanding to process new money requests. This is not as simple an exercise as it sounds. Most of these lenders have processed a significant amount of PPP applications and will have some operational bandwidth issues. What we're wanting to make sure is that we understand on the backside what the avenues and the sources are for delivering an efficient process and how we can access the capital through these traditional SBA means. So what does that mean for you as a borrower? As a small business looking at accessing an SBA program, you really have to set your focus on, and you have to set your expectations around there's more timing. There's personal guarantee structure, and there's paperwork. But specific to the paperwork, I think some things you could do in preparation for requesting funding through the SBA is to make sure you have a business plan that is drawn. A business plan or a specific action plan that demonstrates what you're going to do going from non-operating to maybe partial operation to fully operational, and how you're going to deal with the COVID-19 impact and the uncertainty of 2020 impact. That's going to be a necessary component to accessing the SBA capital. So one of the things you can do at the beginning to maybe reduce the overall impact on going through these channels is to make sure you have an action plan / business plan and draw a pro forma. A pro forma, and again, there are services out there that can help you do both of these. But a pro forma essentially just projects how you're going to actually do from a revenue and cost standpoint. Banks will want that on a month-to-month basis, at least through the end of 2020, and then you can probably go to an annual basis 2021. One last thing you need to prepare for when you look at these programs, banks are going to have very little tolerance for risk, as we noted. If the government is going to guarantee 90% of that program, then you'll probably be putting in the final 10%. And so I know that's really a tough pill to swallow for a lot of small businesses who are starved for capital right now. But it's just the reality that we have to prepare ourselves for the fact that banks may not have any tolerance for risk. And if we're going to access capital on the backside, SBA program or not, we're going to be putting in and injecting some capital. And so considering the backdrop of these federally backed programs, SBA programs, they're confusing enough in a normal environment, but what remains confusing to borrowers in this is really going to be understanding of what lenders are going to be operationally ready to do it and what those programs are going to require for stipulations. And what I mean by that is a true SBA program has delegated authority. Delegated authority simply means that each bank can have a little bit of a different credit box around the same SBA program. So what will remain confusing is just kind of understanding how these lenders will perform and what additional hurdles or challenges they'll create for us in the credit process. And then not confusing, but frustrating will be the timing. We probably are looking at a 4 to 6 week credit review period. Just again, we have operational bandwidth issues and the product itself, SBA, is a little bit clunky. So even though you can typically do a credit review over 2 to 4 weeks with an SBA product in normal times, I would extend that to expectations of 4 to 6 weeks. That also goes to the backside of the SBA program, which is funding. And so when you get into closing and funding, you probably need an additional 4 to 6 weeks. Prepare on that item, prepare yourself timing-wise for the changes that will be coming alongside of just the paperwork. We need to add that timing expectations into all of our projects in terms of accessing the capital.
Thanks, Brian. Thank you for all that information. Clearly, a lot has happened in such a short period of time, and things will still evolve. It shows you how fluid the environment actually is, and having access to the correct team to advise you at this point in time is fundamental and necessary to give you that right guidance. Let's move on to questions and answers. It shows you how interesting this topic is. We've been inundated with questions here, so I've just spent a little bit of time scrolling through, and we'll try to time cap this to be conscious of time here. The first question is from Mike in Texas. You touched on this a little bit, Brian, but maybe a little more detail. His question is, PPP round 1 addressed approximately 1.3 million of the 36 million small businesses in the marketplace. How many businesses will round 2 serve, and is a round 3 likely based on what we've seen?
Well, obviously that's an important question, because if you're not in on round 2 currently, you may not be able to access the funding as the way that the lines and the queues are built. To answer that question specifically, though, round one was probably had a little bit of a larger ticket than and ticket I mean average loan size than round two. Banks have been chastened by a little bit of political pressure on some of the adverse selection that they had demonstrated. Some banks, like Bank of America, had very large average loan sizes, so it looked as if they were probably processing some of their larger clients first and going down. I think there was enough political pressure that this is truly a first come, first serve. That will reduce the average size of the loan because of the amount of small businesses. The average loans could be under $150,000 for 2.5 times payroll. So we're probably going to end up in the second round funding more than the 1.3 million small businesses that applied that first time or were funded the first time, but not nearly enough. Even if it's 2 million or even 2.2 or 2.3 million businesses, we're still going to end up at a vast minority of actual small businesses that qualify for this program will actually receive the funding, which leads you to the second part of your question, which is, will there be a PPP3? I don't think there will be a PPP3. It's an unknown, and there could be enough political pressure based on the lack of businesses that actually receive the funding. But I think the cost to new money requests going forward and the cost to banks operationally and the future cost to banks on the audit portion leads me to believe that they would probably try to create another program or fund the SBA, Enhanced 7A, and Express programs that we talked about, overfund that and try to drive people through normal channels. But as of right now, if you're sitting there and you're thinking to yourself, I should apply for the PPP, I would do it immediately, but you'd have to lower your expectations about getting funding and realistically not project a third one as being available.
Thanks for that, Brian. Let's move on to the second question I have here. It's from Steve in Massachusetts. He's asking, what will the PPP knock-on impact be to commercial leases and commercial real estate value?
Well, the PPP is that impact is really access to capital, which will filter down into impact on commercial real estate. But the number one impact to commercial real estate is just the COVID-19 environment overall. We're expecting realistically a wave of new inventory maybe coming to market. Landlords are in a position where over the last month, 50% of the rental obligations were paid less than full. 30% weren't paid at all. And so when we were taking a look at the commercial real estate market and the impact, it's the impact of the COVID-19, the uncertainty, the future uncertainty for consumer confidence, the uncertain future in terms of access and capital, as we talked about. The PPP, unfortunately, won't help landlords too much. 25% of that funding can be used towards rent, which might carry 1 month. If there's no avenue to access capital beyond that, as we talked about the traditional SBA channels, then we expect an increase in small business and tenant failure, unfortunately. And so landlords, I think, know this. They have their own capital stack issues. And some of the landlords are going to have an issue if more and more of their tenants are not able to pay the rent. So what we're doing in terms of if you're a new tenant looking at this market, what does landscape look like? It's not as simple as saying, great time to go because the market's going to reflect that type of pricing. It actually trails a little bit. So right now, landlords are just getting very squeezed. And so the thought process is not going to be, hey, this was $40 a square foot, now it's 20, because they're looking to put in tenants. They still need to project whether or not a tenant can pay and whether or not this economy can support that. So I wouldn't expect the thought process in a market, even in this type of a shakeout, I wouldn't expect commercial real estate to simply have a precipitous drop in terms of price per square foot or value as a new tenant. But what I would do as a new tenant is really focus on all of the terms and conditions around timing, because everything's going to increase in timing. COVID-19 has impact on your builders. They cannot have more than a certain number of people in a closed room at the same time. You're going to expend more time in terms of construction. You're going to expand more time in terms of decision making. Your real estate owners will likely have less capital to inject or less flexibility to incentivize new tenants. And so it's a new world in that regard, and one that requires just understanding all the variables, some variables just projected at right now. But I think that if you're looking at just specifically what terms and conditions will be impacted by this, I think any terms and condition around timing inside of a lease and then any of the true tenant incentives that are included, whether it's ownership, capital injection, or periods of free rent. Those things are going to be hard to define, but we're going to be watching them closely.
Thanks, Brian. Just moving on to the next question. I think we have time for one more here. A lot of similarly worded questions, focusing on the first two that you've answered here. This next one is from Pete in San Diego. He asks, I have a new business hoping to launch in July. It's not yet operational. I will need financing and capital. What are my options?
Well, basically lines up with our conversation. Really, you've got to drill down just a little bit further. If I were discussing directly with Pete in this regard, I'd say I'd want to know what's involved. Are you launching on July 1, or are you just looking to begin accessing capital on July 1? It's going to have a legitimate impact in terms of the response. As of right now, we have a few people that are, a few of our businesses are interested in moving forward on projects, and yet we're paused. Because the capital sources are just so focused on delivering the PPP that we have a 2 to 4 week pause already on that. So if it's just about accessing capital starting July 1, if that's going to be the project timeframe, we talked about the fact that we think this is going to be an SBA world, and in between now and then, I think I would be preparing myself with drawing a business plan and working with service providers to help them do that if they need it. But you'd be putting together a pretty detailed business plan that demonstrates that they understand what the market is that they're launching into and how they're going to navigate that. And then I'd be building a pro forma. These are things that are inside of our control. We are going to be looking at SBA products as we discussed. So that business plan and the pro forma are two of the items that typically elongate the credit review process. We don't want elongated credit review process because it's already elongated. So just given the fact that they're going to have a surge of applications, there's going to be very few places to go for capital that's not fairly backed. We already expect timeframes to be in the 4 to 6 week range on credit review. So to prepare for that and to maybe make things more efficient, I'd be working on building my business plan and building a pro forma. And I would be making sure that I had access to capital, whether it was on my own personal balance sheet or through a family loan structure. But inside the guidelines that are acceptable to the SBA, I'd be making sure that I had 10 to 15% of that capital on hand for injecting. But in terms of preparing to open a business for July 1 on the capital side of things, I think you're looking at an SBA program, and I think those are the most important things to do that are in your control, is the business plan, pro forma, capital injection, and then get ready for the paperwork.
Okay, great. All right, thanks, Brian. Unfortunately, we need to draw the questions to a close at this point. However, rest assured, we will make the questions and answers available on the Practice Advisors 360 website. That will launch shortly, and the information will be available soon after the release of this webinar. If you haven't already done so, please register for upcoming webinars as part of this series. The links provided on this page, you can see that as practiceadvisors360.com/webinar/. That'll take you to the registration page. This will help ensure that we keep you informed with the upcoming schedule. In addition, you can subscribe to the Practice Advisors 360 YouTube channel. On entering the YouTube website, search for Practice Advisors 360, and you'll have the opportunity to subscribe to that specific channel. This webinar that we are recording will be published to that particular channel, so it can be available for future consumption. In the meantime, if you have any questions or require advice, and advice is a major theme that's come out of this in terms of partnering with a trusted advisor, please reach out to Brian and his team. There is the email listed on this particular page, as well as a phone number that you can reach them directly. But for now, this draws this particular presentation in the series to a close. Thank you for your time today, and please stay tuned for more information about our second Impact webinar, shortly to be released.